Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 26th of April. My name is Carl Capelingua, and I'm the market analyst over here at Think Markets, and it's a pleasure to be with you as we recap the week that was, look to the week that will be, and a whole lot more. Before we do that, let's talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. Four fantastic reasons to make sure your next ASX share trade is with Think Markets. And if you are a new client, you'd like to join our family over here at Think Markets, 5 free trades to get you started. There are some terms and conditions, so of course get to the website and check out the finer details. The agenda for today is to have a little bit of a quick look at Bitcoin. Of course, we're not all about Australian shares over here at Think Markets. We do have a wide cryptocurrency offering. It just got bigger actually over the course of the last week. So definitely ask your advisor over here about crypto and how to get started in that. So we'll look at Bitcoin this morning. We'll check out some of the key macroeconomic data news from last week. Our ASX focus sector for the week is the materials sector. I've got a few stock picks for you there. Then we'll see what the brokers are saying about Australian shares, see where the value is in the Australian market, see what the technicals are saying, and then have a look to the week ahead. Plenty to get through. Bitcoin chart on screen, as I promised. It is actually trading a little lower than what I've drawn on here. So I took this snapshot last evening. It's probably around about sort of 48.5 at the moment, and then that means it is probing into this low down here around about 47,500. It has broken what I think is key technical support here at 50,000. Prior to that at 55,440. Unfortunately for Bitcoin and cryptocurrency traders more generally, it's probably signaling a little bit of a turning of the corner for Bitcoin. Now, the cryptocurrency universe is much, much bigger and far more interesting than Bitcoin. Bitcoin is not my preferred play in the space, and maybe we'll do a whole webinar or session on that in the not too distant future. But to keep this session brief, just looking at the time already, let's just say that I encourage you to go out and investigate that space a little further. Bitcoin is probably turning the corner. That doesn't mean we can't see even, by close of business today, the beginning of a turn higher, but we might well see lower major peaks ahead, even if we hold around this level. If we do get below 47,500, we can fall much quicker, unfortunately, I think, and target that 42,000 level, which would just reinforce this thesis of lower peaks and lower troughs in the interim. Doesn't mean it's the end of Bitcoin. It's probably just the end of the beginning. It's not the beginning of the end, because who's to say that we can't see it make a more broad base pattern than the one we've seen so far, and then turn higher and hit 100,000 by year end or early calendar year 2022. Probably getting a little bit further out than what a daily chart deserves, but hopefully that gives you a little bit of an idea of what's going on in the space at the moment. Having a look at Australian shares, the S&P ASX 200 down just 0.4%, the broader All Ordinaries Index down 0.07%. Digging into the sectors, gold, materials, healthcare, telecommunications were the stronger performers there, and on the downside, energy. We had some quarterly production reports from Woodside and Santos, which disappointed. And late last week, that downgrade from Origin certainly didn't help either. So a 4% fall in the energy sector. Technology taking a little bit of a break. And we had a weaker than expected report from Netflix in the US, caused the NASDAQ to fall back a little. And our technology stocks, some of the shine taken off their recent rally as a result. And then property, a little bit of a pullback there. They have had a pretty strong start to the month prior to that. And look, otherwise it's a bit of a much for muchness. The volatility index did edge higher, but is still far lower than where it was in March. Some of the reason for that elevated volatility in March was the rapid rise in bond yields. And we're looking at the yield of Australian 10-year government bonds here. We have been keeping an eye on this for the last couple of months, on the back of the volatility it did create. It's encouraging to see us still around that sort of 1.6 to 1.7 zone, and the bottom end of that elevated range there from 1.6 to 2. as long as we see it staying around this level here, I think that's the best case scenario for the market. We don't want to see it going down here because that would indicate a large rally in bond prices. Don't forget, bond yields move inverse to bond prices. Bonds themselves are a flight to safety instrument. So if bond prices were to rally to cause yields to fall down back to 1.2%, that would be not good for the stock market because something bad would be happening. We don't necessarily want to see it go too much higher either because higher yields start to impact on companies' profits, our ability to spend, etc., etc. Moving on to the ASX 200, the benchmark index for Australia, we can see that it did pull back during the week. The pullback here was triggered by not much more than rumours, really. There were some media reports that President Biden was about to announce an increase to the capital gains tax regime in the US. That, as you would expect, caused some nerves in the US market. We responded with quite a negative open on Wednesday, but fortunately by the close we had pretty much erased all of those gains. And then Thursday and Friday were very, very strong confirmations that there is still plenty of latent demand in the system. And when you see these shadows, and it doesn't matter so much what the body colour is. So I'll draw one with a white body on the left and one with a black body on the right. The one on the right is what we saw on Wednesday. It's the length of the shadow, that's the key here. And that shadow is indicating demand in the system. Now, you might say, how do you know that's the case, Carl? Are you just making this stuff up as you go along? Not this time. The only way you can get to the bottom of this range, don't forget the candlesticks are just indicating the range of movement on a particular session. So let's move this one over here and say that at, let's say it's 11 a.m. in the morning. Okay, so an hour into trading, which is actually pretty accurate, an hour into trading, the Wednesday candle looked something like this. So it was a big black candle at one stage. Okay, where the open was whatever level it was, but it's the same level there, and the low was at the same level. Now, the only way you can get from this big black candle back over to here is with lots of demand coming into the system and supply actually pulling back. And even if supply didn't pull back, the demand was more than enough to overwhelm that supply. So you went back up and caused that close there. So it does indicate demand in the system. When you get the follow through on Thursday and Friday, that's an even stronger indication that there is latent demand out there. It doesn't mean that the demand is prepared to pay higher prices and push us through this resistance at 7095 and take us back to the all-time high at 7197. It may only wish to pay current prices or lower prices, and that's something we have to just wait to see if that demand will come in and is prepared if it appears that there is no supply left here to pay higher prices. And that's the only thing that can push us higher. If the demand is prepared to just sit back and wait for pullbacks, then we may just consolidate around the current levels. So we will continue to watch this situation very carefully. Of course, you get an update every Monday. Having a look around the world, the Nikkei was down a couple of percent. Unfortunately, I didn't see what the rationale was for that, but I'm sure you could Google it. I'm not getting too concerned because the rest of Asia, Shanghai, Hang Seng, Korea were all modestly higher. In the US, we did see some very, very small falls, but the important thing there is that they were closed well off their lows for the week. So again, track that back to what I mentioned about the Australian market and latent demand in the system. Doesn't mean stocks can necessarily power higher because we need to see how desperate that demand is to get hold of shares. Okay. The volatility index edged up about 6%, but is still lower today than where it was a month ago, and certainly lower than where it was 6 months ago. In Europe, they were down about 1%, but they closed on Friday before the bulk of the US gains, and therefore that should follow through and erase, the positivity should follow through and erase most of those losses when those markets open this evening. We've talked a lot about those US markets. We've talked about the potential Biden capital gains tax hike. There was a Netflix disappointing earnings in there, and I may have got those arrows the wrong way around, so forgive me. But net, we closed pretty close to those record highs and certainly closer to our higher levels of the week than the lowest levels. The short-term trend is clearly up. The long-term trend is clearly up. And yes, there are a couple of little supply events in that chart there. We did talk about what a supply event looks like last week. If you didn't catch it, it looks a lot like that. It looks a lot like that. It looks a lot like that one there, or a lot like that one there. Yes, they're black. Yes, they're pretty much all black in terms of very small shadows, but I don't think they're large enough to disrail the short-term trend at this stage, and certainly nowhere near big enough to disrail the long-term trend. So happy to keep the faith there on the US market. We may consolidate a little bit, which is what the NASDAQ looks like it's doing beneath this 14,176 high. But again, looking pretty positive here on the short-term trend, on the long-term trend, and I can't see anything too sinister that would suggest we couldn't continue to go higher. You can see clearly here that volume is at a depressed level, certainly than where it was in February and March, but not dissimilar to where it was around April, May last year, around this time last year. And look at the rally we saw through here. Certainly you could argue different circumstances, but this low volume is not certainly not the death knell for the markets. In fact, markets can rally very, very well on low volume indeed. Low volume in an up market simply means a lack of supply, and that the people who are demanding are prepared to pay higher and higher prices to get hold of that supply, to force supply into the market. Having a look at the commodities complex now in London, almost across the board, we saw some pretty good gains, just steel rebar and zinc missing out, but both of those are up for the month. Big gains on copper, 4% in London and nearly 4% in New York. Iron ore prices in China spiking 4% higher. We'll talk about those in a second, as we will for the Singapore dollar price, which is up 2.5%. Precious metals broadly higher as the US dollar was weaker. The Australian dollar rallied slightly. Energy down a little bit last week. But the energy chart, the West Texas crude oil chart, looking quite constructive for gains. We do have an OPEC meeting on Wednesday, so we'll watch that closely. And then on the bonds front, we did see a small pullback in bond yields, which is supportive at current levels for the market. This is our chart of where the S&P 500 is this time around compared to the last crisis in the GFC. As you can see, I've changed the colour a little bit and changed the base to match perfectly up with the absolute low in each case. It's still telling us largely the same information, however, basically how we're going this time compared to last time, and we can see that we have moved almost lockstep in this crisis compared to the last crisis, which would pose a little bit of an issue when we get to this point here, which is probably a couple of weeks away. Where do we go from there? Do we follow the 2009-2010 trajectory, or do we create our own history by continuing to go higher? Hey, don't panic. There's absolutely no reason why these two lines should be the same. It's just a little bit of fun we have on Monday mornings, but we'll keep an eye on it all the same. Keeping an eye on the macroeconomic data from last week, Australian retail sales edged 1.4% higher. That was ahead of expectations for a 0.6% increase, and certainly better than February's result of a decrease, of 0.8%. Certainly, we have seen a general, moderation from the big bounce back post-COVID and post-lockdowns, but hopefully we're also seeing maybe the beginning of a small uptrend here, certainly supportive of local economic growth at this stage. Having a look at manufacturing and services data out during the week, they were definitely supportive of future economic growth in the Australian economy. So the composite index, which is the manufacturing and services sectors combined, rose 3.3 points in April to 58.8, and that is a survey record, very impressive. The services side of things, that rose 3.1 points to 58.6, also a survey record, and the manufacturing sector rose 2.8 points to 59.6, also a survey record. So some very strong data out there on the Australian economy. Having a look at the US economy now, the data was a little bit mixed, and I think really the only one that missed here was existing home sales, which were 6.2 million. The estimate was a number of 6 million coming out, and we had an actual there of 6 million, so slightly down on the previous month, but certainly in line with the expectations. New home sales, on the other hand, shot the lights out. We saw over 1 million homes on an annualised basis sold up to the month of March. That was well ahead of the 886,000 expected, and also well ahead of February's 846, which was revised significantly higher as well. All in all, the trend there for the US housing market, which is a major engine of US economic growth, on the way up. Also on the way up was the Conference Board Leading Economic Indicators Index, and there are about 10 sub-indicators in this, which speak to manufacturing, various parts of the economy, services, price expectations, business conditions, and so on. And that came in at 111.6. That was slightly ahead of expectations and nicely higher than the February result, and nearing the all-time highs which were set before the COVID crisis. All 10 of those sub-indices were up, I should also add. Having a look at the services and manufacturing sectors in the US, a similar result here to the Australian data. We saw the services PMI come in at 63.1. That was well ahead of February's 60 and well ahead of expectations. On the manufacturing side, 60.6, well ahead of the prior month's 59 and the 59.6. Estimated. This survey has only been charted by my data provider for a few months now, so hence the lack of detail there. But if you look more broadly on the trends, the manufacturing sector is very close to a all-time high, and the services sector actually made an all-time high with that print. So the data is looking pretty good there. Also looking pretty good in the US, where we saw 586,000 jobless claims, which is not a good thing, of course, but that number was better than expected and better than the previous months. So there are fewer people claiming for unemployment support this week than the previous week, and the trend is still down. What's normal, though? Pre-COVID, you're looking at somewhere between 200 to 250,000 was a pretty typical weekly jobless claims print, and you can see that is still way below than where it is now. So there's still plenty of work to do. Continuing claims, so these are initial claims. Obviously, there are people who have been claiming for many weeks. They did fall during the week, but there are still about 18 million Americans unemployed, so plenty of work to do there. Okay, sector in focus this week is the materials sector. This is the chart on screen now. You can see short-term trend is clearly up, long-term trend is up. The candles look great. That Wednesday pullback, just creating another high peak and another higher trough. We are testing the all-time highs here around 17,000, and there's no reason, I think, that we couldn't actually break through that level, especially when you consider how well the iron ore price is doing at the moment. That is the US dollar price based in Singapore. Obviously, Rio, BHP, Fortescue, the heavyweights of the materials sector with large exposure to iron ore. This is the price in Shanghai, also moving back towards those highs and looking very, very constructive indeed. And Fortescue, well, what do you notice about those three charts? So that's the Shanghai iron ore price, that's the Singapore iron ore price, and now let's skip forward again to Fortescue. Well, based upon the iron ore prices, which are back up to their highs, Fortescue appears to be quite a long way behind at this stage in its progress. The other thing here, now that's sort of fundamentals, I guess, the pricing of iron ore. Now, one of the main reasons for this underperformance is that a lot of the big research houses, a lot of the big brokers out there have an estimate for iron ore around about $100 to, if they're really bullish, maybe 110 or 120 a tonne, right? And they're all expecting that when the price falls back to that, Fortescue will be more appropriately valued. So they're saying, well, around about $20 is where Fortescue should be valued if the iron ore price falls back. But it's looking less and less likely that this is going to occur. And the longer the price stays up around not 110, 120, but around 180, the more money Fortescue is going to be making. It's currently on a PE of under 6 for FY21. So these are forward-looking PEs. It's on a dividend yield of about 14%. When you look further out, now those numbers fall slightly because, as I said, brokers are expecting earnings to decline. But on an FY22 basis, the PE is closer to about 8. The dividend yield's about 9%. FY23, you're looking at the PE going up to about 13 and the yield down to about 6. My point is, the longer the prices stay elevated, those FY22 and FY23 numbers have to go up. They sound pretty good to me anyway, but they're probably going to get better, which means Fortescue can facilitate a much higher share price, in my opinion. I like the fact it's pulled back into this short-term uptrend zone. Now, this is a weekly chart, but the same concepts apply. I like the fact that the long-term trend is still very, very strong. I like the candles. I like the setup. I can't see any reason why this one can't continue to do well. So I'm happy to be a buyer on Fortescue at current levels. I'm happy also to buy Mineral Resources. Now, this one has iron ore as well, and it also has lithium. How about that? So it's got all the good stuff, none of the bad stuff. It's had a great base pattern through here. We're back to a daily chart, of course, but it's looking very, very constructive indeed. Yes, I would have loved to have been buying it in that 40 to 36 range. We've had a buy on this for many, many months, by the way, in Think Technical, but I just think if you're waiting for a pullback, you might get disappointed. So I'm happy to also be a buyer on Mineral Resources at current prices. Certainly a buyer on James Hardie. This one is far closer to its consolidation / breakout zone. So I think that's also encouraging. Candles look fantastic. Short-term uptrend, long-term uptrend. These guys are a major beneficiary of that booming US housing market. We saw some data out on that earlier. Also, increased spending on infrastructure as well. So they have a huge part of the business in the US and are well placed, therefore, to take advantage of an improving US economy this year. Moving along, this one's a little bit off the beaten track, but it does coincidentally have a big US exposure. They have a borate and sulfate of potash mine in California, and they are about to go into production probably around about September, October this year. It's not a small cap company, despite the fact it's not producing anything yet. It's a capitalisation of about 750 million. But the reason why the capitalisation is so large is the company is planning by about year 5 of operations to be earning on an EBITDA basis about 600 million Australian per annum. So if you're earning 600 million in EBITDA and your current market cap is 750, putting aside the fact that there is massive execution risk between now and 5 years, potentially you're looking quite cheap. But those who are able to look forward and keep the faith and have a longer term time frame are clearly happy to push the price of this high, as they have done certainly through here. We've had a really nice consolidation phase for the last few months, and we are now breaking toward the top of that range. Look, happy to be a buyer around that sort of 190 to 2 level, but if you can't get it, you may have to buy on a break of 213 this week. So some really interesting materials sector plays for you to check out when markets open shortly. Having a look at the broker moves for the week, Morgan Stanley upgraded Bank of Queensland from equal weight to overweight. That was on the back of the company's half-yearly results the week before. Dexus got upgraded by Morgan Stanley. Also, Morgan Stanley saying, hey, look, the office segment of the property market is probably going to turn around. People are too bearish on it, so have another look at Dexus, and they actually upgraded the price target by a substantial amount. They're 41% and still seeing about 16.7% upside from the current price to their target. Galaxy Resources announced a merger of equals with Orocobre, and the market reacting quite positively to that one. Galaxy getting an upgrade from underperform to neutral from Credit Suisse, and a 78.6% increase in the price target, which implies the stock is probably fully valued though. Having a look at the downgrades during the week, Amcor outperformed to neutral, API from buy to neutral. They had some profit numbers out. Alumina, Challenger, Main Pharma, mainly ebb and flow. Essenter Group from Morgan Stanley, I would say that's part of a broader review of the property sector. In terms of price changes, Galaxy Resources in the news, we saw that Credit Suisse there. We also talked about Dexus, Orocobre, the other part of that merger of equals, getting an upgrade. Oz Minerals, big copper and gold producer. Copper prices, as we saw earlier, up 4%. So brokers were responding to that. AP Eagers out with some pretty fantastic earnings. If you're interested on some of these broker moves, certainly catch our broker moves review on the website. It will go into all of these in far greater depth. BlueScope and Sims doing well as steel prices move through the roof. We've talked about the other ones there. Look, I'll let you catch the broker moves review for an update on the rest of those, because I'm just seeing we are behind time. The Australian market 1 year forward PE around about 18.6. It looks favourable compared to the rest of the world PE there, but you would hardly say it was cheap. Materials sector does look cheap. You've got PEs in single digits for our big iron ore producers. I think it's an opportunity on the back of, I wouldn't call it a miscalculation by the brokers, and they're lower than market estimates of iron ore prices. Hey, that's what they're supposed to do, but it's starting to appear that iron ore prices could stay higher for longer. It means they'll have to adjust those higher, and we're going to get higher valuations and therefore higher share prices for some of those shares going forward. The next cheapest is the energy sector, which there are some cheap-looking stocks out there. Woodside, Santos come to mind, but they've had a tough time lately. And then the financial sector, there's been some news out on Westpac this morning, but I haven't had a chance to look at it yet. They obviously have their half-yearly, and we're getting half-yearlies from NAB and ANZ this week as well. Having a look at the technical side of things, I'm a little bit disappointed to see a drop-off because a couple of weeks ago we were up here. So I'm a little bit disappointed to see a drop-off in the participation in this rally in the short to medium term. I mean, really sort of out to 2 months. It's still encouraging to see that we're up here for the longer term trends, but this is a bit of a question mark for me. So even if the market only stays steady for the next few weeks, I want to see the participation increase. So I'm watching that with some interest. Having a look to the week ahead, big data out on Wednesday for Australia, the CPI, that's the Consumer Price Index, so giving us an indication of the rate of inflation. The expected number is 1.1%, and that will take us to an annualised rate of 1.7%, which is nothing to worry about as far as the RBA is concerned. But they will be cognizant of the fact that part of that 4-quarter print, last quarter, so the June quarter, was a minus 1.9%, and next quarter that's going to drop out. So if the next quarter, so that'll be the corresponding June quarter, is a 1-odd percenter, you're going to see this number here pop up to potentially into that 2 to 3% target band by the RBA. So probably nothing to panic about at this stage, but certainly something to watch very closely as we move closer to that June quarter print. Other than that, it's all much of a muchness. We do have some OPEC meetings which will obviously go across all of the markets. Having a look to the global economic data coming out for the next week, on Monday we're going to get core durable goods orders, something I watch very closely because it is a data print that reaches across all sectors, and it is also a very forward-looking number. We do have a US Federal Reserve meeting, which will no doubt be watched extremely closely. We do have advanced GDP out shortly thereafter, weekly unemployment claims. We do have some more manufacturing data coming out from China. These are the official government numbers. And then some key data out on Friday. This is the data the Fed pays a great deal of attention to. So the core PCE price index, that's their preferred measure of inflation, employment costs, personal income and personal spending. Okay, thanks for joining me this morning. You can catch all of our other market updates in our market news section of the website. You can follow me, all the Think Markets handles on Twitter. We do have an Ask the Experts on Wednesday. You get to bring your portfolio to the table, but you must register for that in our webinars section of the website. You can see a couple of other ones coming out over the next couple of weeks there also. The disclaimer before I leave you says that everything we've talked about this morning is general in nature. We do have some products that could see you lose more than your deposit, so please read this disclaimer carefully, and if you have any questions at all, please give us a call. Thanks for joining me this morning. All the best for your trading. Until we catch up again, bye-bye for now.